Hey, Jim, thanks so much for joining us on the podcast today. I really appreciate you taking the time.
Thank you for having me.
Yeah. So, you and I have known each other for a while. We met way back when having conversations. But I wanted to start this conversation off with, we had exchanged some information in advance about different topics, and you had made some comments about perspectives you had about consumer lending that had changed that I thought were really interesting. And so I kind of wanted to dive into that. Do you want to share those for the audience? Then we can talk about them a little bit.
Yeah, sure. So I think, along with many others, used to think probably 5 years back that banks were going to have to turn themselves into software companies if they really wanted to compete and be sustainable long term. Common belief was that fintechs were disrupting and the money center banks had unlimited budgets to invest in software, and community banks weren't going to be able to keep up. And my view on this has changed quite a bit over the last 5 years. So somewhere along the way, I think fintech stopped thinking they were going to completely replace banks and started to embrace the partnership model.
Yep.
Obviously, Upstart, great example of that. But that combination with banks and fintechs makes a ton of sense. Fintechs bring the innovation, the customer experience, typically an obsession with a single product, a healthy obsession, and expertise. Banks have a lot to offer as well. First, we've got customers. We're very good at being regulated. We're disciplined. We've earned a lot of trust over the years because of all those things. But we also have balance sheets. We've got all the other products and services to eventually offer customers as well. So, I definitely think banks, community banks like WSFS, need to be more tech savvy, and we are. We're getting there. But I no longer see fintechs as that pure disruptor that I thought they would be 5 years ago. I think fintechs are coming around to that as well.
Yeah, I mean, I've been saying this for a while, that I think the ultimate combination is banks plus fintechs. And I think fintechs have to choose. Either you become a bank and build up, to your point, some of the assets that banks have that
Right.
give them advantages in the market, or you choose to partner. I think some are choosing one path over the other, but I think that model is about right. How do you think about the money center banks and the big banks in this space? I mean, it's interesting because I think most of them still are investing a lot of money. I mean, some people throw around the IT budgets for these guys, and it boggles my mind. They're not. I don't think they can be spending them all that well with how big they are. They must be doing something. But how do you think about how that changes how you compete with the big banks who are still spending really large sums of IT? I think you're right on the fintech partnership side, but I'm curious your thoughts on how the competition with the big guys changes.
Listen, I'm not sure what kind of return they're getting on their investment, but they're doing a good job. And I hate to admit it, they've developed good products, they've developed good experiences. Their technology is hard to match in a lot of ways. It's still easy for us as a community bank to contrast what we do to what they do. Right? We're in the market, we live in the market, we know our customers, we have local decision making. So, I mean, we compete with the big banks every day, and they're good at what they're good at. But we still like our competitive position as a community bank, because I think we have a different level of trust with our customers.
Well, let's dive into that a little bit. So you talked about, the assets banks have and bring to the party that, helped you either, not be as concerned about fintechs, but really bring to a partnership model. How do you think about the core assets that a bank has in this world and what value they're bringing, and things like how do branches play into that, things like that? Like, what do you think of as those core values?
Yeah, so to me, I think there are three big components in why a customer might select a bank. Price, the economics have to work. It's got to be convenient, and there's got to be trust. And every customer values those three things very differently. It's harder, I think, in digital channels to build the trust component, but I think digital channels are really good at the price component and convenience. So those are pretty strong. The way I think about the branches is there's still a ton of value in the human touch, and I think at our company we're very good at this, and we do a good job at it. Our head of retail banking always says that our service model is experiential. So it's something you kind of have to see in person to understand it. So we don't want the branches to completely go away. They're a great opportunity for us to showcase what kind of makes us special as a community bank. But the role of the branch has completely changed. Customers go less often, but for more important things. They go to get something fixed. They go because they're trying to troubleshoot their app. They go to get advice or to buy something. And because branches, people don't go quite as often, they don't have to be on every street corner anymore. Customers are willing to go a little further because they're going less often, but they definitely still want to have access to people, and they want to be able to look somebody in the eye when they need help with their money. For us, there's two big things that need to happen for this transition to really fully occur. First, we need to get some of the routine transactions out of the branches. Things like depositing checks. Otherwise, we're going to be too bogged down with that to do anything else. And second, we got to elevate the talent within the branches so that they can really be true advisors to customers. And that doesn't happen overnight. It's easy to have that vision as to what it eventually needs to look like, but the trick is trying to execute on that transition over a period of time while balancing what customers want and quarterly earnings and everything else that goes into retail banking.
I love that model, Jim. Less often, but for more important things. I think that's a great way to describe the role of the branches in the modern world. And then I think the description of fewer, but maybe a different more trained staff to handle the more complex issues is a really, it's a good description of what I've kind of roughly heard some people talking about what's going on. How do you think about the time frame for that and the core efforts to have your branches ready to handle that? Because it does seem like you're kind of, in some ways, putting less on the branches, but frankly, in some ways, putting more on the employees in terms of they're not really transactional, operational roles anymore. It's really more of an advisory role, which was maybe, I think, a goal for branches in the past, but it sounds like it's becoming more of a reality in the core of the branch's role. How do you think about the core steps you have to take? If somebody agrees with that, like, how would you recommend somebody says, this is how we go about transforming our branches to serve those kinds of needs?
Yeah, this transition's been happening for a very long time, 10, 20 years. So our transition at WSFS started with going from personal bankers to the universal service model. So that was a big transition for us. Now it's kind of the next evolution in that, where they're going from universal service models to just advisors. Everyone kind of thinks it's going to happen overnight, where a couple years from now there's not going to be branches. I do not believe that. I think it's going to just be a slow transition to those branches just being less, as I said, not on every street corner anymore. So it's been happening a long time. It's going to continue to happen. Most of it's happening through bank consolidations. Every time you see bank M&A, there's a fair amount of closures just to try to optimize the network, and we've been part of that as well. So it'll be a slow journey.
Indeed. Now, one of the other things I wanted to talk about in the context of this kind of shift with digital and the different role branches are maybe playing is how you think about what a bank does to earn loyalty and the opportunity to, I think one of the core things to the business model is selling multiple products to a customer, having a customer interact with you for multiple products. How do you think about how you earn that? I mean, I feel like it used to be the branch was nearby, so when I needed something, that's where I went, and that's how the bank retained that relationship. Obviously, that's shifted a little bit. How do you think about the core elements you have to achieve to earn that kind of loyalty and that multi-product relationship with a customer today?
Yeah, great question. So it's different than the branch model, right? Completely different. In the digital world, as you guys know probably better than anybody, you got to be easy to deal with. You can't ask for the same information twice, less clicks, optimized for mobile, integrations with other apps people are using. And all those things build value for customers. But like I said in the past, it's harder to build the trust component. So I think if you really got a purely digital channel, you have to be ultra convenient and the price needs to be really good. And if you can do those two things really well, you can earn cross-product loyalty, even without, the trust of looking somebody in the eye. So I do think it's possible.
I think maybe one of the things we're going to have to learn as an industry how to do effectively over the next couple of years is how to maintain that level of trust. Although I totally agree with your assessment. I mean, I'm the same way. I want to transact on my phone, but there are certain times when I have questions and I don't want to look up an FAQ. I want to talk to somebody and go, how do I handle this? And that engenders a tremendous amount of trust when I can turn to somebody and get a real answer in conversation about a more difficult question.
Yeah, and as a community bank, We have customers that want to come in the branch every day. We have customers that don't want to talk to anybody. They want to search for banking solutions at 3 a.m. on their phone. So we're in a difficult spot because we have to serve, that wide range of customers.
Mm-hmm. No, it's true. You do. And you don't have what I think some of the fintechs have relied on, which is, serving a segment of the customer as well that likes the way they transact. But you really do have to meet people where they're at, which is, a wide variety of starting points and preferences, which is a little bit more holistic, I think. One of the things many fintechs don't appreciate about the challenges banks have is that their customers can run the spectrum in a way that's not always true for online-only products.
That's right.
So if you don't think banks are becoming software companies, and particularly community banks, regional banks, building their own experiences, it seems like you need a way to get products in market that are new, that you're not developing in-house. And I think that kind of leads naturally to this model of partnerships with fintechs. So talk to me a bit about how you approach that, how you think about it, what you guys have been doing. Because I think it's an interesting model, but frankly, I'd love to explore how you do it well. Because I think many institutions I've talked to have struggled with whether it's diligence processes, implementation, actual execution of product and market. Those partnerships can be alluring, but challenging to really execute on. And so I'd love to understand both your strategy behind where, but how you do it well. Because I think that's not a widely shared skill set among many institutions at this point.
Sure. So we've been doing lending partnerships for a long time, but we really committed to it starting maybe 5 years ago in 2016. And the reason for it was we wanted to diversify the consumer lending business. Our commercial lending business was growing at a really great pace, and we wanted to be able to keep up with that and hopefully to learn a little bit along the way because we were seeing everything that fintechs were doing. You have to be dedicated to it, and you have to dedicate resources to it, and you have to have very clear accountability internally as to who owns it. Right now, we have, I believe, 3 partnerships within our consumer lending business. The way we think about it is our core competency is HELOCs. So we do that ourselves. That is our business that we think we should be focused on, and we try to get better at that every day. We do home equity installment loans as well, but that's a harder business. It's a little more difficult, a little more compliant. So we do have a partnership in that space because they're the experts at it. Same thing with student loans. They can be tricky. We have a partnership in that space and now one with Upstart. So our strategy is not to pretend that we're experts in everything, and we partner when we think we can create a better experience for customers.
I like that strategy. Talk to me. I thought your statement on dedicated resources and dedicated accountability was really interesting. One of the things I've seen is the number of different functions in a bank that has to get involved in these decisions. So I'm curious where you think about, when you talk about dedicated resources, where within the institution do you have dedicated resources, these kinds of partnerships, and where does accountability sit? I mean, I've seen it in innovation offices or in the line of business or somewhere in a corporate strategy group. Like, how do you think about the accountable party and where they sit within the institution, and then how dedicated resources work and the kind of cross-functional teams that are involved in the diligence and execution of any kind of partnership?
My prior role before retail lending was the head of corporate development and strategy. So I was part of sourcing and trying to uncover these partnerships. So I think that's the best way to funnel opportunities. But ultimately, the business lines have to own it because they're the ones that are held accountable for financial results and other things. So it was kind of interesting when we started talking, Jeff, you and I was in that corporate development role. And it just so happened that my next role was, consumer lending. So I went from being like the beginning of the funnel to the end of it, which was actually a really great transition. But one of the reasons that we have so many successful partnerships within lending is there's just clear accountability. That's how we generate loans within our consumer lending book outside of home equity loans. So when you have that accountability and it actually can help you hit your budgets and gain new customers in market, you get it done.
Yeah. Do you see any tension in, so you're kind of defining the corporate strategy role as you kind of find some stuff, but ultimately you're, owned by the line of business. Do you ever see, maybe I'll say not tension, but what's your best advice on how you bring those two together? Because I can see a world where there's an interesting partnership. The line of business is not interested, maybe feels some ownership and, hey, we do this, okay, we want to make it internal. How do you manage that cross-functionally? Because it's, you can have differently aligned interests or different perspectives between the person sourcing a deal or an opportunity and the person who ultimately is going to own the execution of that partnership in the long term. It works out great for you. You found it, now you own it. But I imagine that's not always true.
Yeah, I think the best way to handle that is for corporate development or whatever the strategy arm is, to be asking the business lines what they need. So they know what they're looking for. And if the need is, we're not very big in the student loan space and we think it's an opportunity, they can go out and find that. If the need is, we think we can do personal loans better and we can actually bring in new customers because of that, they go out and try to source opportunities. So it's got to be a collaboration, and it should start up front.
I like that. So you're almost like a services arm in some ways, from the point of view of the lines of business who are saying, hey, here's the needs I have, what's out there in the space, as opposed to, coming from a top-down strategy. Hey, here's the thing you need to be doing, and consumer are like, good luck. We found a deal for you. Go execute it. I like that. That makes a lot of sense. And I'm curious, you've got a couple partnerships. How did you think about the areas in consumer lending that were most intriguing or enticing? You've got a pretty wide range, with student lending being, I guess very similar to unsecured installment, but kind of pretty low yield. Home equity installment loans, which are kind of similar to the HELOCs that you have. How did you think about, when you were in that strategy role, the most interesting categories of stuff that were going on and the products that were maybe most interesting for your customers?
Most interesting products were the ones that we didn't think we were the best in the market at. So we basically weren't in student lending, or we did very little of it. So we wanted to partner with who we thought was the best in the business at the time. Personal loans, we did next to none. And we saw the growth in the industry, and we weren't participating in it. So we try to just be very honest with ourselves about what we're good at and what we're not, and partner where we think it's appropriate.
Yeah, excellent. So I want to kind of continue the theme of, so you're not a software company, you're making partnerships, but I imagine there are still core IT and infrastructure assets that you think the bank does need to be investing in order to be successful in the long term. So how do you think about what are those kind of institutional or infrastructural investments that make the most sense for you, and how you do spend, the IT budgets that you're not spending on software development for these new platforms or these new products? Like, where are you investing that you think makes sense for the long term?
Sure. So we're trying to invest a lot in our back-end systems. So we're trying to create better processes around more modern solutions. I think too many digital transformations focus on that front end. And especially for lending, you end up with an online application that isn't much better than a web form. And then it goes through the same manual process as it would have if it came in on paper. So we see a lot more value, getting a lot more value out of better underwriting systems, processing, workflow, CRM. And then we could put on that front end system down the road, and it would be a true digital first solution that's actually functional. So the other thing we've found, that investments in process have really, really positive impacts on employee engagement, because our employees can spend less time on tedious workflow work and more time on the fun stuff, helping customers, improving other parts of the business. So that's been our focus.
Interesting. I have one question to follow up on. I think it's a very smart strategy, to be honest, Jim. Because the front end, the web form, not that sophisticated, but how you can turn that into an experience is a lot about back end. I'm curious how you're approaching, or if you have any advice on kind of unifying data infrastructure internally, because one of the things I do find is you can focus on back end, but if it's siloed, then your ability to serve a customer cross-product, or for your banker to have a holistic view can be challenging, or even just to do like a marketing analytics on the value of a customer relationship if I've got 3 different systems that are on the back end. How do you think about that need to be well designed for a specific product versus having the ability to have kind of fully cross-institution view of a client?
We launched what we call our delivery transformation, which is major investment in technology and data infrastructure, maybe 2 or 3 years ago. And part of that was front end investments to help improve the customer experience, but a major part of it was what we call infrastructure, mainly data infrastructure, which is multi-year product or multi-year process, major investment, lots of work, but it's not the most interesting investment you can make, right? It's not something that pays for itself in a year or 2 years. And it's definitely not easy. So we've been at it for a long time. We're starting to make progress on that front. We're trying to supplement it with CRM systems and other things to really bring that together. But I would just say it's hard, and we're working through it. And the value will come down the road, right? Especially as we end up putting really good front end solutions on our infrastructure, because then they actually are functional.
Mm-hmm. So one more question on this: how do you think about how does the institution get on board with making that kind of investment that pays off in the long term, but maybe not the short? It's maybe one of the hardest problems in investments in general and technology investments in particular is it's easy to optimize for what I can get some value in my next P&L planning, my quarterly results. I'm going to put money there, and not the stuff that is really transformational over a multi-year time frame. How do you think about making those decisions and getting the institution on board? Because I think it's a place a lot of people fall down, and you end up, optimizing for the short run and missing the longer term trends that are really important.
So we have a pretty good discipline of doing a 3-year strategic plan. Obviously every 3 years, and we meet with our entire board and executive management team for multiple days off site to figure out what our strategy is. And our delivery transformation started there. So it started with complete buy-in from the board and executive management team as to what we were doing. And some of those investments, like you said, don't have quick payback. So the key to it, especially for a public company that's got quarterly earnings and things like that, is just to commit to it and communicate it. And communicate it to every constituent you have, from associates, employees, to customers, to investors, and continue to show progress to the board. But everybody from top to bottom has to be committed to it.
I like it. Commit to it and communicate it. I don't know if you pre-planned that phrase, but that's a nice little phrase on how to get it done. So the next thing I wanted to talk about a little bit was, what's the biggest challenge you guys have faced in the last year as an institution, and talk to me a little bit like how you approached it, what it was, how you approached it, what results you've seen. It's been a challenging year on many fronts, I imagine. The last 18
Yeah. No, let me think.
A couple answers there.
So PPP, I'm sure a lot of bankers have said this, especially the first round of PPP was a huge challenge for banks. Our company was no different. There was limited guidance, changed every day. Customers were going crazy, manual processes, the systems crashed every day. It was crazy, but at the same time, probably the most rewarding thing myself or any of my coworkers have really ever been a part of. Yeah, I think everyone who works in banking knows how important it is, what we do for customers and our communities, but nonetheless, the reputation of banking has kind of been on a decline for some time. So PPP was a really cool opportunity for us bankers to step up and more directly help people during a time of need.
That's interesting. I definitely had heard PPP as a challenge, but this sense of reconnecting to the mission and the community through that effort I hadn't heard that before. It makes sense because it was certainly a chance for the industry to step up and really help out. And I think it went remarkably well. Were you guys happy with how it went in the end? I mean, it seems like despite all the challenges in the end, people were able to distribute funds, help out businesses, and really make a difference. Curious if you had any thoughts on that.
Yeah, we were happy. I think most importantly, our customers were happy, and it worked. I mean, asset quality results across all of banking were saved because of that, and customers were saved, and jobs were saved, and it really was a successful program. It was broad and it was big, but it did its job.
It did ultimately achieve the results that were desired of it. So that's despite the challenges in execution. That's great. And then the last thing before I get into my final 3 questions is there anything you've executed on recently that you've been surprised by the results of, or that kind of, you weren't expecting quite what you got?
Yeah, again, this is not unique to us. It's actually not unique to banking at all, but we were really surprised by how well the transition to working from home went. Obviously, there were plenty of challenges. Those challenges still exist today, but we had done drills in the past to test our remote workability, and they went okay at best, right? But I think this really just highlighted our ability to adapt and innovate when we had to. I remember back, one of the early days of the pandemic, our CEO said to me, people hate change, but they have a remarkable ability to adapt. And I think that shined through here. Now we're finally starting to come back to the office a little bit in person. That's more change that people have a wide range of opinions on, but overall it's gone pretty well so
Are you
far.
expecting any permanent shifts in your work strategy? Have you guys not decided yet if you're gonna make any more permanent shifts? I mean, I think every company is struggling with some of this seems better, some of this seems worse. How do we balance what we liked and what we didn't with, the kind of need to get back to something resembling normal? And obviously, banking institutions have a more substantial challenge in that branches may be fewer, but they're not, to be an in-person interaction, you got to be in the branch. So I'm curious if you've got any long-term perspective on what you're going to do or shift because of the experiences you've had.
I think the world's changed, and clearly there's going to be things about how we work together that will be different in the future. But we have tried to avoid making bold declarations about what our company is going to look like going forward. We're not going to be 100% remote ever. We're not saying everybody's back 5 days a week, tomorrow. So we're trying to really learn and stay flexible because things are changing every day, and we're still trying to listen to what our associates are telling us.
Yeah, I think that may be smart. I know some of the Silicon Valley companies have made bold proclamations about what they're doing, and then secondary bold proclamations about how they're changing the bold proclamation they made 6 weeks ago. So right. I think we are still all trying to feel out what the real future feels like and what the right answer is. So maybe a little bit of prudence and wait and see makes sense. All right. And the last thing I've got, Jim, I think you saw these in advance, so hopefully you're prepared. But I always like to end these conversations with the same kind of 3 questions. So I'll be curious your answers. And the first of them is, what's the single best piece of career advice you've ever gotten?
So I was told pretty early in my career to listen more than I talk. And I try to live up to that, but far from perfect on it. And not just about the ratio of how much you talk versus you listen, but really the quality and how people listen to each other. I think all too often, especially in business, during meetings and other conversations, people are so busy thinking about the next thing they're going to say that they're barely listening to what the other people around them are saying. And I really think that listening is a skill, and it makes you a better employee, but I think it definitely makes you a better manager and better leader.
Like I was once told, you have 2 ears and 1 mouth. Use them accordingly. And this is a hard one for me, but I like it. And I will say, one of the things I find that feels awkward when you do it, but I'm impressed when I see it, is that pause when somebody has clearly been listening, hasn't thought of what they're going to say, and is processing and going, give me a second to think about this. I want to respond, but I haven't got it, because all too often you're immediately ready because you haven't really been paying attention. So I like that piece of advice. So how about the best piece of advice you've gotten about the consumer lending industry or business?
So this goes back to how we handle partnerships, but my predecessor in retail lending said to me that it's much easier to disrupt a product that you're not already successful in. So like I said, we basically weren't in the student loan business when we decided to disrupt and partner in that space. When we partnered with Upstart, we were doing next to nothing in unsecured loans. So relatively easy. We weren't risking a whole lot. I think it's going to be a lot harder to potentially disrupt a business where we're generating lots of assets with good returns, even if we think it makes a ton of sense in the long run. There's going to be a lot more pushback on that type of initiative.
Do you have any advice on how to do that? I mean, I think this is kind of the classic innovator's dilemma, that you can make the right choice for your business in terms of maintaining and keeping doing the thing that's generating the income when maybe you're missing the train on the thing that's going to totally shift it. So I agree with you, but at the end, maybe you do want to shift, whether it's a mortgage business or a commercial real estate business. You need to innovate in those spaces that are the driver. Do you have any advice or any thoughts on how you actually do that in the end?
So I think it goes back to when we made technology investments. I think you've got to get full commitment from everybody, and you've got to communicate it. Other than that, it will be a challenge.
All right, challenges are always fun there, but they'll make the job interesting, right? In my
Yeah.
last question, do you have a bold prediction about the future for us?
Yeah, so I think it's inevitable at this point that big tech is going to get into lending. Still, probably in some sort of partnership
Mm-hmm.
with traditional banks. You're already starting to see it with Amazon getting into working capital
Mm-hmm.
loans. Google and others are making really, really big venture investments into
Mm-hmm.
fintech. I ultimately see them getting into some of the more complex products. I think it'll depend a lot on regulators and their appetite to allow them into the
Mm-hmm.
space. And I could be wrong on this. I don't see any of these big tech companies wanting direct regulatory supervision from any of our regulators, but I think they're going to find a way.
Interesting. Well, I mean, the nature of bold predictions is that you could be wrong. Otherwise, they're not bold enough. Do you make a prediction on who you think enters the space first? I mean, I think you see Amazon certainly playing around the edges with some of their business. Google has the Google Pay app and a number of financially oriented assets where obviously a lending business could easily fit. You want to make a prediction on which of the big guys gets in?
Probably your old employer.
My old employer. You think Google? Well, Google, if you're listening,
Yeah.
call me up if you want some advice on how to do that. I like Jim's prediction. We're happy to help you out. But I think you're probably right about this space. And I don't know, the regulatory landscape will be interesting for these guys because they are clearly facing more scrutiny from existing regulators, let alone if they came in and had to deal with some of the financial prudential regulators. But it may be a muscle they're having to build anyway, and they may decide to exercise it in different ways once they're obviously spending a lot of money on their presence in Washington. So big tech in lending, Jim's bold prediction. Jim, we're going to bring you back and figure out if you were right about this one. I have a feeling it's not a bad bet. Well, Jim, I appreciate your coming on today. This was a great conversation. I think a lot of interesting things, and you got a lot of little tidbits. Less people coming to the branches left often, but for more important things, and commit early and communicate often. I think some great pieces of advice, and I really appreciate the conversation. This was fun.
Thank you for having me.